Good morning, everyone, and welcome to our panel, Unlocking Investment in Europe. I know it's still really early, but I hope everyone got their first cup of coffee. And I promise this discussion will be just as energizing. I'm Lola Onipko, co-founder of Invest and Bravery, an organization that works with startups in defense and resilience sector, connecting them with investors. And I will be your moderator for this session. The motto of this SMEs Assembly is Successful SMEs Competitive Europe. But Europe stands at a pivotal moment. The SMEs, the heart of our economies, are facing multiple headwinds. Insufficient investment, declining productivity, lack of skill, and of course, climate crisis and war on our continent. To stay competitive, we need to enable our companies to grow. And that means unlocking the investment. So let's unpack today how we can do it. What holds us back? Where are the opportunities? And how we can make Europe the best place in the world to start and grow a business. Let's welcome our panelists. So we have Sine Lindestrom, Director of Small Medium Enterprise and Entrepreneurship at Danish Industry, leading initiatives to improve access to finance, cut regulatory barriers, and strengthen Denmark's startup and SME ecosystem. She previously also worked at the Danish Export and Investment Fund and Finance Denmark, Sine. Next, we have Jasper Hjalbak, one of Denmark's top angel investors, president of European Business Angel Network, vice chair of Danish Venture Capital Association, the former chair of Danish Business Angel Network, awarded Business Angel of the Year in Denmark in 2023 and in the EU in 2024. Jasper also chairs the private equity fund CaterCap, sits on the board of multiple growth businesses, including B&O or Bang & Olufsen, and lectures at Copenhagen Business School. Hi, Jasper. Next, we have Vincent Jocquet, managing partner at Ready Ventures, a Belgian early-stage VC backing ambitious European tech founders. Before investing, he was an operator in both software and hardware scale-ups, giving insights on both sides of the table. And last but not least, we have Arthur Kasperstorm Tekelbjerg. That is definitely was the hardest name to pronounce today. CEO and co-founder of Spark Technologies, a Copenhagen-based startup building an AI-native platform for public affairs professionals. It's great to have you here with us on stage today. So we will take some time for discussion, 30 to 40 minutes, and then we will open floor for Q&A. So please use sliders to submit your questions, and we also will give the opportunity to ask your question in person. We will have a mic passing around, so whatever feels better to you. And without further ado, let's dive into the discussion. According to the latest Investment European Bank survey, investment intent remains remarkably strong. 86% of companies are still planning to invest in 2025, just slightly down from the last year. But growth is winning, and the shift and the focus on the investment is shifting. Only about 26%, or 1 in 4 companies, are planning to expand capacity, to invest in land, building, infrastructure, meaning that most are modernizing, but not scaling. And 35% of total investment already goes to intangible assets, such as R&D, software, and training. So Europe is transitioning, green, digital, but cautious. Depending on the size and stage of SME, whether it is startup or scale up with traction who are looking to expand their businesses, the companies are facing very different realities when it comes to accessing capital. So let's unpack why and what holds us back. Vince, let's start with you. You work with early stage companies and venture capital. How do you see the investment climate today, and what are the biggest gaps holding VC growth in Europe?
Thank you, Lola. I think from our perspective, we see that there was a big boom in 2020, 2021, and we gradually, 2023, saw the bottom of this, and now we're moving up again. So I think Also in other panels, we've seen positive outcomes, let's say cautious positive outcomes currently. But that also means that we're more disciplined and actually we're more selective. And I think for VC investing, that is a good thing. I think we don't want to spray and pray. We don't want to go too far. We really want to focus on the ones that can actually create value. When we look at the current, let's say, challenges, we've been looking at the past a lot during this SME assembly, and I think also for venture that aligns with what we see as current gaps. I think the biggest gap undoubtedly is the single market or the lack of a single market. I think what we need to do is collaborate more across the borders, collaborate more with each other. I think we should also start more to buy from each other. I think that's the first thing we can do while we wait for legislation. But we need to show that it's necessary. I think the second gap that we see is that the deployment of capital is skewed. There is deployment in early stage, there's deployment in later stage. But if we see that along the startup journey, there is a gap with funds not being able to deploy 10 to 50 million when there isn't a growth need, then also for us as early stage investors, the road for successful building bigger companies is also blocked. So we need, for early stage, we need to see the future also. We can't have the spark ignited, but then not be able to put more fire on the wood on the fire. That brings me actually to the third point, and I think that's also essential, is that we still have a gap in investing in VC in Europe. So if you look at other continents, we see much more money going and flowing into VC. We really need to encourage this, and I think it should be possible to create more fuel for startups, and so we could also see more growth, because there's no growth without fuel. It's kind of a vicious circle.
Amazing, thank you. Thank you for bringing those points up. And Jesper, as an angel investor, you're often the first believer. But what's stopping private capital to flow freely and more into early stage startups?
Yep. First, if I set the stage, if you look across the EU and you look at the angel networks, we see a very, diverse landscape. And broadly speaking, the further west or north you are, the more sophisticated, and the further east you go, the less sophisticated. And the reason I say this, it means when you want to address policy matters, there is no one size fits all, at least measured on a national level, because of the different levels of sophistication. So this means that my organization too tries to help those less developed angel communities to develop by taking the best practices from those that are developed. Having said that, I've been angel investing for 20 years. I have seen initiatives at the EU level which have failed, not because of lack of good intentions, but because it took maybe 10 years before the member countries had adopted it. By the time they had done that, they had done it in a very diverse way. So what started off as an intent for a pan-European set of conditions ended up 10 years later with a mosaic. And this means that when you're a startup trying to scale, you're not addressing a single market, you're addressing 27 markets. And that obviously is a huge problem compared to the US and to China. So therefore, if I'm going to talk solutions, and it's probably more constructive, but I think the number one solution would be the enactment of the 28th directive. And I know there is intense work on this happening, but there are all kinds of interface problems between having a European kind of layer and the interaction with tax legislation in 27 countries, etc. So the point is
let's definitely dive into this in the next block, and I would love to cover a little bit more on the 28th regime, because I think that's something that our audience is
so then I'll carry on with the problems. Just two final problems is to say that when we have this real lack of risk capital compared to our two main competitors, there are two reasons. One is over-regulation of the financial sector, which as a response to the financial crisis of 2008, the EU went into overdrive. But actually, before that, there had been, courtesy of a Danish prime minister, a big scare about hedge funds, and so legislation was put into effect, which also affects, business angels, and it is completely out of proportion to the risks that angel funds could attract. None of them represents systemic risk, but they are treated in the same fashion, the same legislation as hedge funds that move billions per day. That is ridiculous. And the other thing is, obviously, that in many countries we have a capital gains tax, which is prohibitive. So these two items, they're not new, they're very old, but until we get moving on this, we're going to see risk capital being 1/10 of what it is in the US, despite having the same market size. It's our own fault.
Definitely something that holds back. Thank you, Jesper. And Sine, you work both with startups, but also scale-ups, or in other words, SMEs with traction, larger scale company who really looking to expand. So maybe first of all, drawing on startups, do you agree maybe that with what's been said? And also, how does it looking for scale-up? Why are they cautious? Do they experience similar problems? And also from a policy point of view, what structural barriers are still there that prevent investment from flowing freely?
Many good questions. If I should start with the analysis on early stage funding, I agree that it's very different in Europe, and actually the access to early stage funding has become much better in Denmark the last 10 years. This is not where we have the largest challenge. The large challenge is growth capital, and we share that with the rest of Europe. So this is really here where we need to step up. Being cautious, we ask our members just recently, what are the growth barriers for you? And it's all of our companies we ask. We have SMEs, entrepreneurs, also the large companies. And the number one challenge is insecurity. Insecurity about what is happening in the world, of course. Tariffs, geopolitics, and so on. You all know what is at stake here. And the second and third one are administrative burdens and lack of employees. So this is some of the explanations I think here, and some of it we cannot do anything about. So it's to have a focus. What can we do ourselves here? What actually is within our scope of handling things? And I have this story which I would like to share now, because this is a story about what is at stake here. What is at stake here when we say that the US, they have better markets, and China, that is really pushing the market, and there's so much public funding in the venture market. And this story was the other day. I just stared into the screen because I received this mail from one of our startup members. I know him very well. We often talk together. He is racing now. He's racing a seed round. He has started companies before, so he's an experienced founder, and he is developing within energy efficiency. And he told me that he just went to this conference the other day at Danish Industry. And then when he was finished, he met accidentally 2 Chinese individuals. And they was quickly to have a talk with him about what he was doing, and they were very interested. And just in 5 minutes, he was invited to come to China. And they would pay all of it. And 2 weeks after, he was on his flight to China, and he came back, and he was so impressive because they have made all the trips for him. He was introduced to companies and dinners, and they were talking about investment and this incubator they have. They would like him and his team to be part of. And when he came back, he just received this NDA from them. So I was just so quickly there. They move so fast, and he was really impressed about how far they are within the manufacturing sector, because this is where he developed his technology. It is for this sector, and they are really far ahead. So this is just a story on what is at stake here. Because of course he likes to be in Denmark, but he's also looking for funding, and here is someone that is really wants to collaborate with him, and they are not waiting. So this is really something we need to be aware of, because in Denmark and lots of places in Europe, we are very good at innovation. We have good universities. We have a lot of talent. But when it comes to scaling and reap the fruits, we are losing here.
Yes, and this is a critical point that we probably will come back later in the discussion as well. Thank you. Thanks, Sinead, for sharing. And we have a founder here with us as well, Arthur, and you have raised already 1.5 million, I believe, in your latest round. Share from your founder perspective, how easy or hard was it for you, and where did you face the biggest barriers in securing your investment?
Yeah, sure. Well, yes, that's correct. I raised a pre-seed funding round of 1.5 million euros about a year ago, and I think there are a lots of learnings from having raised a round like that. We raised it from Swedish investors, so it was European investors and also even Nordic ones. And I think that in general, investors look for companies that are good, right? Companies that grow fast, that create value, that have a good business case, and the startup community is extremely international. And it's when we have spoken to investors, they are of course comparing us to companies all around the world, because every investment case is only a Zoom call away. So whenever we do a pitch, they look at our pitch deck, they look at our numbers, they look at our traction, and they look at the American companies, they look at the companies in the UK, look at the companies even in Asia now as well. And we are all getting assessed by the same parameters. And the issue is not so much that there isn't capital in the market. I mean, I think we're sitting here with two people that make investments on a regular basis, and I think that if the right investment came by today, you guys would probably invest on the spot. Mm-hmm. But the issue just is that it's extremely hard as a European startup to grow as fast as a company in the US, who is maybe doing the same thing that you are doing, or a company in Asia who is doing the same thing, because of some of these things that, for example, you, Jesper, is mentioning. I mean, extremely fragmented market. We have way higher costs when it comes to regulatory or legal requirements, because there's such a fragmented framework for laws around the markets that we want to scale to. There's also a large language barrier in some markets. You see some markets, even here in Europe, where it's not possible to have an online sales call in English and sell a product, whereas in the US this is culture and something that they do and see as completely normal. So it takes a lot more effort to get a customer. It takes a lot more effort to do a market expansion, and with effort I mean resources, time, money. And I think this is the biggest roadblock to raising capital, because I've never had an investor not say, well, yes, we want to take a call, we want to hear about your idea, we want to see your numbers. But I think the hard part is just getting compared to a company that has way less, you can say, barriers, and a way bigger and more homogeneous market. So these are the things that I see as the biggest barrier to receiving investment, not that there isn't capital. So we can talk about the 28th regime, which I think is a brilliant initiative, and we can talk about lowering burdens for small companies. But I think it's a very easy or clear-sighted impression that you get as a founder when you sit and talk to investors in the US or in the UK. You get a very strong impression that they're looking at you and comparing you to someone else, and if you just aren't able to grow as fast because of these things, then you're not the one getting that investment. Simple as that.
Yes, so the competition is really, really global. Thanks for sharing your perspective from a founder lens, and that makes a perfect bridge, I think, for our next question. And really, I would like us to get a bit more practical now and speak about what can we do to make investment bigger, faster, and smarter across Europe. And maybe let's start this time from you, Sine. From your perspective, which policies or EU initiatives could have the biggest impact? Maybe something we can do short term and something will take longer time to build and implement.
Well, I think the SafeMe Investment Union is very important because we need to mobilize much more of the private capital in Europe, and there are several things to be done here. First of all, it's how can we get more of the pension funds, the institutional capital, flowing into venture and growth, and it's just the facts say that it's just too little that are being invested here. I read this analysis the other day where it showed that American pension funds, they are investing more in German startups than German pension funds are investing in German startups. So it's not you can really get a good return here, but it's about culture. It's about being aware now. How do we the big savings we have actually large savings, especially also in Denmark. How do we invest this? We need to be smart here. And therefore, I'm very happy with this scale-up fund, Europe Scale-up Fund, that are going to start up next year. The sooner, the better. And the purpose is to blend private capital with public funding, and it's very important because this is going to be a very huge fund. It's going to invest in C and D rounds. And we don't have these funds in Europe. So I think it's really important now that these initiatives, they will be rolled out and it doesn't take too long. And then we must see how it works and go back and see if we need to change something. And also we need to, all the member states need to look in models and how we can make it attractive for pension funds. There is some red tape. I know when I talk to the pension sector, we need to remove that double reporting that makes it very difficult for them to invest in this segment. How do we implement regulation? Our national financial authorities are sometimes very strict. So here we really need to look at that and remove that. And that is part of this SafeMe Investment Union. And then we also need to look on how we can get more retail investors to invest here. There are good examples in Sweden. They have the Aktiesparekonto. We also have in Denmark. In Denmark, it could be much better. But this is a way where we can also invest in this segment in startup and scale-ups and SMEs. But we need to have a model for it, a possibility to invest. So, and here we can learn from some of the best. And I think Sweden really has found a very good solution with their Aktiesparekonto.
Thank you. All very good points addressing the lack of scale capital regulations and how to unlock investments that now might be going somewhere else in case of pension funds, retail funds. I think yesterday we've heard at Access to Finance panel as well that some of the pension funds in Europe also invest outside of Europe, which is, hopefully that will also change over time. So Vince, if you could design the ideal environment for early stage VC, what would it look like? And any tools or mechanisms that could unlock more early stage capital?
I just want to comment on what you said with the focus of pension funds investing also abroad or outside of Europe. I think investment managers are being rewarded for return. So that actually implies that you're saying that outside of Europe, there's better opportunities to invest. So I think linking that to your question, we need to be able to make ourselves more competitive. I think that's the big word that has already been on the lips of people for a long time. And when I listen to what Arthur says, we need to go faster. I think fast is essential. Fast doesn't mean that we're uncautious, that we're not meticulous, that we don't do our job. I think we just need to make sure that the environment that we create on all levels is faster. Because our ICP for us as an investment fund is the startup founder, the team. So we need to look into what they need, right? We don't need to look into secondary, we need to look into what we need. And then we need to look into what people need to give us to be able to eventually give it to the startup. So I think we need to think all about the ideal customer profile and or consumer profile. And our profile is the startup. So if they want to go faster, if they need money more quickly, then we need to be able to also deploy it. So if we think from a business point of view, we need to go fast, and also from a policy point of view, it needs to align with these, let's say, mindset. So I think it's a big mindset shift. So my ideal environment would be that we're all thinking entrepreneurial, and that links to the everyday entrepreneur. Maybe we should all be a little bit more accountable for what we do as an entrepreneurial feeling. We are the entrepreneurs of our own family, but we need to think about that also in a business point of view. We can't hide away from everything that happens. We can't hide away beyond, let's say, the red tape and bureaucracy. An ideal environment is an environment that can thrive at the right moment with the right funds in the right place. And I think we need to create the place, to create the environment of funding. And eventually that, for me, at the moment, is linked to fast, because fast is quantifiable, fast can be measured. And I strongly believe that if we all want to go a little bit faster, that potentially we can create more of that essential environment and breeding ground that we need here in Europe.
Speed is critical. Couldn't relate more to this for sure. Thank you. And Jesper, what would help mobilize angel investment capital across Europe, especially cross-border? You already started talking in the previous block of questions about 28 regime, so share more with us. What's your perspective?
Yeah, first of all, on the 28th regime, the reason why that is interesting is because you could create a pan-European platform where the ambitious startups could incorporate, and where the institutional investors then could look across a European selection of startups, as opposed to having to understand 27 markets. And if you look at the institutional investors, in certain countries, actually there is some, movement, and they are increasingly allocating some of their funds. And here I'm talking about going from 0.6 to maybe 2 or 3%. This is what I'm talking about. So I'm not talking about a large proportion, but something that would be much more constructive. Mm-hmm. Yeah. By having this platform, then you can match these, very ambitious startups to venture funds that have seen the light, if you like. That again does not negate the importance of acting at the national level also. We have in EBAN given the Commission 5 or 6 examples of very successful instruments in which you can attract financial institutions to invest in this area. I think the most famous of those is the TB initiative. Philip TB was here at the Tech Barbecue in August. He was at our summit in Brussels 3 weeks ago. He has managed first to attract, I think it was 9 billion euros, and in the second round, 7 billion euros. Then you are talking amounts which actually can move the needle. So because this is the very frustrating thing. We have excellent innovation in our universities because they're publicly funded, and so they do a lot of good work, and they're not private enterprises. And we have lots of money in Europe, but we're unable to match them. And the awful thing about development of companies these days is that in the digital age, for a lot of companies, not only is it a global competition from the start, but it's also winner takes all. And the Americans have understood this. You can see some of the examples of some of the big tech companies. How many years did Amazon or Uber have a loss? More than a decade, and they poured money into it. We sit there and we do this drip feeding, this slow startup, and that kills the scaling, And so the Commission came up with a report in end of May, when there was one diagram which I would like to have shown, but the great thing about this diagram is it addresses the fact that we have 2 funding gaps. One is with the angels, and the other is with the scaling up. Now an initiative has been taken to do this very big scaling up, and that is important, but it's actually also important to address the angel side. And there are people who have understood, even the Commission, that having a healthy angel environment feeds the startups, because then you can draw upon the experience of angels. We always call it clever money. So it's not the size of the funds provided, it's the experience, the connections, etc. So you need to have a thriving angel community. This 28th directive would enable the most ambitious angels also to work there together with the most ambitious venture companies.
It's great to see that synergy coming across between angel venture and scale-up capital,
Yeah.
both private and public together.
And it's not an easy cooperation. I've been to Silicon Valley several times. You speak with business angels there. Half of them say, when the venture funds walk into the room, we walk out, right? And the other half say, these are my great partners. And then there was a correlation, because the first category, that's in Silicon Valley, where everybody stabs everybody. It's a wonderful competitive environment. And the other half is so-called flyover states. And this is between the East Coast and the West Coast. And the flyover states, it's small communities, so the venture funds and angels have to behave. So that gives two different types of cooperation. We are 27 small countries. We should learn to behave and cooperate, and I think we can. And this platform would help us to do that.
Thank you. And Arthur, from founder point of view, what do you think would truly move the needle to make fundraising easier and faster for you?
Yeah, I mean, I think a little bit back to my point before. I think that the barriers and the issues are primarily within helping companies grow, not so much raise capital. The dynamic of the investment market is very much that the best investments get investment. So I'm not too worried about being a fast-growing company and not getting funds. I think this is something that will probably be solved by the market itself. But I think that there is a couple of issues. One is that what kind of companies do we want to create in Europe? Do we want to make these really, really big winner-takes-all companies? Because then it's going to take a complete mindset shift that is sort of a societal one. That means that we as a society will be happy to keep pouring money into companies with a loss, you can say. Because what is the value of having a market winner? Like, what is the value of having an Amazon or a Meta or a Google or an Uber? It's extremely hard to put a price on having a globally dominating market winner in your country. And we don't really have that many in Europe. I mean, if you look at the largest stocks in the world, like all of them are American or Chinese or even now Middle Eastern as well. So I think, first of all, we need to think about what kind of companies we want. Do we want to produce more medium-sized companies? Well, fine. I mean, that's what we are doing now. We are optimizing for companies becoming kind of large, but not mega. I believe in the other one. I believe that we should try in Europe to build a society where we can actually produce market winners. And this is a mindset shift. But also, it's about creating this fast track for companies that are super ambitious, that actually have an idea that provides enough value for it to scale globally. 28th regime is a great one. This eliminates some of it. But yeah, I think that there are a lot of, you can say, dynamics in the labor laws as well that are extremely painful to small companies. For example, why does it make sense to found a small startup if you are a person that has an education and is bright and could go on a career track in a large company instead? We at Spark went 8 months without salary to sort of fuel the first couple of months of growth, and we had a business angel join us as well. We had an early stage investment fund as well. But to be honest, it kind of takes you being crazy to throw yourself into 8 months without salary, because none of us who founded Spark weren't admitted into a great university. None of us couldn't go out and get a great position that would track us into a great career later on, which is extremely fortunate and privileged. But it takes being a little bit crazy to start a company in Europe because the other options are so good. And then there's the part about hiring people to join your crazy little company. And I think the upside just isn't very large for people that leave a great corporate career track to join a startup, because even your warrants, if you join as an early stage employee, they get taxed super heavily. It takes a long time before you can get a payout, and it just really isn't that attractive to risk joining a startup and tracking away from your corporate career, because we just haven't been able to, in Europe, create an upside that's huge. That's why we see so many founders leave and build internationally. Most of the Danish unicorn founders are not in Denmark. And when I say most, I mean almost all of them are not in Denmark anymore. So I think there's something about what kind of companies do we want to build? Do we want to build market leaders? Well, then it's a complete shift in mentality. I think we should do it. And then there's the other part, which I think is under-addressed, the labor laws part, creating maybe some labor law rules for people that choose to join startup to make it more beneficial, or to make the upside bigger for those who also want to take a risk and become part of building those companies that will go on become market dominators.
Thank you.
Agree. Good point.
Thank you for the perspective. And so we've heard now different point of views from policy, private capital, founders. I just want to do a quick fire round on how we can put those efforts together to turn investment intent into actual growth. So maybe super quick, one sentence piece of advice, how we can attract and deploy more capital across Europe. Sine, maybe starting from you.
Yes, I would suggest that you look at Denmark and our funds of funds model called Danish Growth Capital. We have actually succeeded in getting pension funds invest in this funds of funds. It started out with this Danish state giving some loans during the financial crisis to the pension funds, and this was to de-risk this investment. And it showed out they got a very good return, and afterwards it is shown that this construction is 100% commercial viable. So this is something to build on. We have shown how we can blend this, and I think we need to do more of this, and we need to understand how can we mobilize this and make it attractive. And this is a very concrete way to raise this risk capital. So that would be my advice.
Thank you. Jesper?
Two things. One is to deregulate angel funds. There is a kind of a nursing attitude, and when angels invest, they can invest directly into the portfolio company, which is extremely risky, or they can join a syndicate of angels and invest into a portfolio of companies. The second choice means you have to follow EU regulation, and it is extremely complicated. And who are you protecting? You're not protecting society because the amounts are insignificant. And you're not protecting the individual because they're taking much bigger risks on their direct investments anyway. So why do you have that regulation? Then if you go to, as a retail customer, to the banks, there are some of them that put you through an exam that if you want to invest in exotic financial instruments, you have to pass a test. So they want to see that you understand the risks in this instrument. Once you've done that, then they can open up the showcase of all the stuff you can invest in. Similarly, you could say, why not have a qualification as an angel? Once you've proven that, then go ahead and make all the funds that you want to make, because you're taking much bigger risks, besides that anyway. So that would be a very good thing to do.
Angels.
Yeah.
Thanks, Jesper. Vince?
Make co-investment easier. So let the money flow into the managers that effectively are boots on the ground with the startups that know where things happen. So I think if we look at the mean or the average time it takes to get public funds in a venture fund, it's probably 18 months or something. I mean, from the moment you write the thesis, you go out, 18 months pass. I mean, your thesis probably also changed a little bit. Investment periods typically are 4 years, so you're already halfway. And typically, this is also a big chunk because that is also the point of having public money. So making that faster, just as I said before, would be and with less hurdles, would allow more money to flow easily into the environment of startups.
Arthur?
Yeah, I mean, I think it's interesting to hear what you guys' takes on this is, because I can also hear that you're thinking about making it easier for the investor, or making it easier for the angel, and I, of course, want to make it easier for the founder. And I think that it's again back to the part about it's a little bit the chicken and the egg, right? And I think that if we produce better companies, then you will find the money to invest in it. And I think also if what's tedious is the investment process, if it's expensive for you to do an investment, or if it's difficult, well, then it's about creating better investment opportunities so that when you go through those tedious processes, and even with the cost that might have for you, it still ends up becoming a really, really great investment for you guys, because the companies are growing fast and generating a return for you. And I think that as soon as the politicians see that we get more people who found successful businesses that end up contributing to society, getting sold, paying a lot of tax money, then they will change the rules as well for you guys. Now we have simplification, like omnibus initiatives and so on, which is of course a great, you can say, test to the will of the politicians, whether they actually want to make it easier for the industry to run a company and to grow. But yeah, I think that it's about fundamentally making it easier to grow a company faster, to generate better returns. This will make it easier for the investors to swallow the hard part of making an investment and the costs associated with it, and will help the politicians also change the rules because they see the benefit.
Thanks, Arthur. Jesper?
Yeah, I
you
just
wanted
had
to
a comment, that in the EU we want to save the planet, unlike the US and China. So we have regulations about this. Then, German industry is challenged, French industry is challenged. So they said about, couldn't we simplify some of the reporting that these small companies have to fulfill, the omnibus. And you have the EU Commission, you have the Council, you have the Parliament. What happened in the Parliament? The extreme left and the extreme right got together and voted it down. So despite the fact that German industry needs help, French industry needs help, these are two very important players. Even if you convince the Commission to simplify, and it went from, was it 1,188 measuring points to less than half that, but it had to go through this machine. And this is our big challenge is the slowness of the EU, the inability to act fast to help scale.
Great.
Yes, Vince.
Yeah, I want to comment on what Arthur said. I think we can create that flywheel by celebrating success. And I think we need to define what means success, right? And success does not always mean unicorns. It means return. It means tangible things. And I think that's also alluding to the fact that what Arthur said is what do we want to create? But at the end, we need to make the goal achievable for everyone. So if we focus on the unicorn decacorn, how is that achievable? We need to focus on returns, 10x returns, 20x returns. That's already companies of 100, 200 million exit value. So if we qualify what is success, I think we can be closer to qualifying what is needed for that success and to make the route possible. Because otherwise we're just doing something and being disappointed along the way and not making successful things. And one more thing that we observe in early stage is that if success currently is defined by making a global company, some companies that we invest in, they set up a US Inc., not a Belgian limited company. And why? Because they work from Belgium, they hire internationally also, but they believe that if they want to receive American investment, they have to have an Inc. So there is a fundamental issue there, because if you're not in Delaware, but you have a Delaware company, because you believe that somebody in the US, where your biggest market is, will eventually invest, then your definition of success is not qualified in Europe, it is qualified in the US. So that mindset shift of EU Inc., which is something that I really applaud, needs to be also in our success stories. We need to talk about Skype, we need to talk about Lovable. We don't need to talk all the time about Palantir or Meta or whatever. We need to tell our own stories. And I think that would definitely bring more interest in what we do, and also have the everyday entrepreneur think about something that they can relate to, instead of all these unicorns that have great losses and eventually make a lot of money for a very few people. So that is, I think, the narrative that we need to chase, and not so much something that is, for some people, a reality, but for most, just a dream.
I think both of you and Arthur, I will give you. Okay. I think we can actually hear from the applause on both comments from Vince and Arthur before that this is a good reflection of what this assembly is all about, because we really want to talk and draw on successes of the huge big companies. At the same time, we don't want to leave behind the everyday entrepreneurship. And yeah, it's a real challenge, what we focus on and how we able to promote both. Arthur, did you want to maybe add something last point?
Yeah, no, I think this is maybe the part of the debate that I care the most about is like the ambition level of Europe. And I think that I maybe fundamentally disagree with your point on what kind of companies we have to. I mean, we have to celebrate all successes, of course. Like this is not something that I will dispute, but I think more like the part of saying we want unicorns and decacorns and global domination companies in Europe. And I think this is the goal number one for our market, is to get into this league, because China has them, US has them, now the Middle East has them as well. We don't really have them. We have very few ones, and for example, founders moving outside of Europe with those companies. And I think that the ones that provide the most societal value are actually the ones that become very, very large. Like you look at Amazon, I think the largest employer in the US. So that's a great example of a company that became enormously large in a very small amount of time, and now creates, thousands of jobs.
800.
Yeah, and I think actually the companies that get sold for, 50 million euros, 100 million euros, and so on, these are the ones where the wealth maybe, tends to stay with very few people and benefit only a couple of the people who run those companies and make those smaller exits, whereas the ones that go public and where the public can buy shares in these fast-growing companies, and where there's a lot of spin-offs from those companies because they become very large, and I think those are the ones where the wealth distributes more into society. So yeah, I think this is a really interesting debate, and I would urge people who work on the policy side to help create those first mega companies in Europe that will play in the same league as Amazon and Uber and so on, the ones we talk about, because they become great successes.
I think definitely a topic for a huge debate. Would love to have more time to go through it, and also would be really good to fund this kind of research to really measure the impact and traction and try to find some data that would support either perspective. I don't think we will find the clear winner here, but that's something to really find out. And on top of it, I couldn't agree more with what we are discussing here in terms of keeping the talent in Europe, focusing on innovation here. And we talk about the solutions, how to do it. At the same time, I have like one maybe additional thought. Alongside the green and digital transition, Europe is now investing into its security. And more and more SMEs are part of this space, developing technology, capacity building, driving innovation. Because security and competitiveness is so deeply interconnected, I believe that our prosperity, depending not only on how we innovate within our borders, but also how we collaborate with our partners outside of it, beyond the borders. From my own work with Ukrainian innovation and defense ecosystem, I've seen just how much potential there is for cross-border partnership, where technology, testing, and capital can really flow both ways. So my own maybe final piece of advice is still collaborate, co-create, and co-invest with our international partners and allies who align with us, with our values, because this is how we build more secure, more prosperous, and more competitive Europe. And so thank you so much for your perspectives. We have about 10 minutes for questions. And maybe I would first ask the audience, is there anyone who would like to ask a question? Yes, I think we have a hand over there. And over there as well. Perfect. And here. Okay, great. I think the audience is not sleeping. They are awake.
Hello, thank you very much for your contribution and discussion. My name is Oliver Geider from Eurocrowd. I have a question to all on you on the panel. This has been a quite traditional investment discussion, and it makes us in Europe look kind of slow. But since the financial, what did we have there, the 2008 crisis, the European Commission has actually moved incredibly fast in creating 2 capital market laws. MiCA, Markets in Crypto Assets, and ECSPR, European Crowdfunding Service Provider Regulation, which allows limited liability companies make public offerings for up to 5 million euros per year. And MiCA also is a tool to finance small companies. But you didn't mention any of them. Can you maybe tell something about this, how this plays a role in your day-to-day business, if you thought about using it, if you have seen any kind of collaboration with these markets? Thank you.
Vincent?
Maybe and thank you for the question, on crowdfunding. I think typically what we see is specifically on a focus group of companies, specifically B2C, because they can tell the story, and a lot of people that acknowledge what they do and see what they do and also want to buy what they do, typically find their way there. It's a $2 billion euro market, so it's huge. So I do think it's a great initiative, but we don't see it that often in what we invest in, because I think most typical VC in Europe focus on B2B. So the ones that do B2C then see this as a growth path. But the reason why it's 2 billion is probably also because there's not a lot of venture going into this. So it is essential that, of course, it gets a little bit regulated, and it is an option for companies, typically small companies, to find their first ambassadors. So I do
B2C, yeah.
B2C, yes. So I do applaud it, but we don't see it a lot in our environment.
Sina?
Yeah, crowdfunding, I think, is a good alternative to many things. In Denmark, we just recently made it possible to raise equity crowdfunding, because that hasn't been allowed. So this is when we need to move that before we can start building up the market. But it's still very small, and really, I have the impression that it's like last resort. So it's when you don't have any other options, and it should not be that. But we really need to have, I think, some good success stories here, and how you can use this in a good way to raise capital. But I also know for some of those that have tried crowdfunding, you need to spend a lot of time on it. You really need to have a very good campaign, and you need to be focused on consumers with your product. For if it's B2B, it's too complex, and you will not reach the retail investors. So it can be relevant for some kind of startups, not for all. But we need the market needs to build up. At the moment, it's very small here in Denmark.
Thank you. Let's take another question. There's a question over here. There.
Thanks. Good morning. I'm Clark Parsons from the European Startup Network. Thanks to everybody for mentioning the 28th regime, and I agree with all the points you were making. A bit of a different question, though, maybe also touching on what you just said. I was quite disappointed yesterday. There was a panel from all of the stock exchanges, and I didn't hear a single new idea, despite the fact that I think the Danish one admitted that there's been 3 years of no IPOs in Denmark. The Chancellor of Germany called for a pan-European stock exchange, because he remembers 30 years ago when Deutsche Börse tried to merge with London Stock Exchange and the EU blocked it. So I want to talk about exits. You guys are doing a great job of focusing on the beginnings, and Startup Network, we are too. Startup capital, scale-up capital, all of this. But you also mentioned the Delaware Inc., which I think is a symptom of the fact that since there's no exit market here, no real IPO market, why wouldn't a founder go to the US? Because you know that there's an exit market there. So I'm just curious to know if you guys have any ideas, besides my pet idea of maybe some kind of early public offering, sort of the crowdfunding thing. We have to innovate. We've got to out-innovate the US. We've got to be attractive for founders to stay here and found here. So I'm curious if you guys have any ideas for how we can fix the broken and blocked exit market of Europe.
Yeah, I just like to add a comment there that there are exit possibilities when I invest in a startup. typically, either you can be part of a consolidation, so you're selling to someone consolidating the market, or if you're very good, the opposite, that you're actually acquiring other smaller startups to grow. Sort of in the first instance, that's an exit. The second is there are venture funds that you can bring in to scale your company. So it's more about the fact that this third possibility of listing and accessing investors, through a stock market, is not really open, and that of course is a huge barrier. Then you have, this is for the founders, if we can create, and we are creating, efficient secondary markets, so that the founder can take some money off the table rather than having to go through the whole journey as such. So I think there are exit possibilities, but fewer than we would like. Having said that, I have been part of listing on these growth exchanges. I've also listed companies on the main exchanges, and most people see that as a destination. It's actually only the beginning of a journey, and you are blessed with then lots and lots of regulations and stuff. So, congratulations that you're now a listed company. By the way, be prepared to meet all the requirements. So it's a two-edged sword, I would say. Yeah.
I also want to talk on exit. I think it's a good remark. Every time we sit with a founder, first discussion even, also goes about exit. There's a group of venture capitalists that don't want to talk about exit because they believe they want to create big companies, and they don't want to talk about the elephant in the room. But I believe that we are, with the advent of AI, we see lots of point solutions. We see that AI is really optimizing efficiency. We see that building a broader company, a big company with lots of, let's say, a suite solution, is not typically what founders currently are looking for. So if we have founders that are building suite point solutions, then the exit route most of the time is consolidation. And then success means 100, 200, 300 million euro exit. It doesn't mean that you can do an IPO because with a point solution, it's difficult. So either you, indeed, as Jesper says, you try to buy your way up. But also, on the other hand, if we look at IPOs, most of the startups that I talk to, they don't see IPO as a route. They see it as a very cumbersome process. There's lots of great initiatives from Euronext and others to inform them about what it takes. But at the end of the day, they don't really want to focus on getting that IPO because they can do much more with less money. They need growth capital when they really want to become bigger. But an exit is not. It's not in the eye of the startup at the moment to really go for that. So what I would see is, for us personally as investors, we see secondary markets. We see that more as an exit opportunity. We see secondary funds coming up primarily in UK, that if we have invested for 6-7 years and we want to make return for our LPs, that take our share and then they can build the next wave. They can wait for the IPO. But if it takes so long, I mean, for us, it's also not a business to go for that. So we typically, we don't push them, but we inform them about the opportunities that there are. And I think IPO at the moment is not one of those cases. Secondaries.
Thank you. Arthur?
Yeah, I mean, I think that to this point, again, it's about like who buys those companies that become 100-200 million euro big. Well, it's the large companies that buy them. Who are the large companies? Well, they are US and Chinese companies. So again, if we don't aim to build those companies that will be the consolidators, then the wealth and the growth of those companies will go to the US and China.
Yes.
So I think, again, my point here would be to say we should maybe focus on creating the rules that allow us to build those companies that actually last. I was in San Francisco as well 3-4 weeks ago, and there the mentality is never exit. Build the companies that last forever, become really, really big, and never exit. Because then you will become the ones acquiring. And I hope that we're going to see more mentality like this in the EU as well, where people are not aiming to exit when they start. They're aiming to build something that will consolidate, acquire even US companies, acquire Chinese companies to build a very large European one.
Thank you. Thank you so much. Sadly, we are out of time, but please find the panelists and speak to them, ask your questions. They're still around for a little bit time here, so please do approach them and talk together. I want to do a quick mention. There is a scale-up event today, right after SME Assembly, starting at, I think, 1 p.m. at Copenhagen City Hall. So for those of you who are staying, please go join, because it also will be investors, founders, policymakers who will be discussing how to improve entrepreneurship in the EU. Just to sum up, we can see from our discussion that Europe doesn't lack talent or capital, ideas, but it needs more scaling capital, and it needs speed. By harmonizing regulations, unlocking institutional investment, and strengthening public-private bridges, Europe can not only close the funding gap, but also keep the most ambitious founders within its borders, not pushing them outside of it. So I want to thank you, our great panelists, Sine, Jasper, Vince, Arthur, for being with us today, sharing their valuable insights, and I would love to thank you, audience, for joining us today. Thank you, and let's keep building this future together. Thank you.